All right, I'm here to talk about the next waves of stablecoin adoption. I'm Nick Van Eck, the CEO of Agora. We are a stablecoin issuer and infrastructure platform. This is the biggest revolution to me since cloud. Blockchain-based finance is going to eat all of traditional finance and payments over the next 20 years. And as we saw over the last 25 years with cloud infrastructure, B2B SaaS, I think we're going to see a similar growth and sort of evolution in industry when it comes to blockchain-based finance, and stablecoins will be at the center of that and are really the first building block. There's about trillions of dollars in the euro-dollar market today. And if we want to talk about why sort of stablecoins are valuable at a high level, it's cross-border payments and access to dollars globally. And frankly, they're just a much better euro-dollar. So I think at the low end, in 20 years, we're going to see the stablecoin market at 10 to 15 trillion dollars, and really just eat this whole pie. And for those that are unaware, euro dollars are sort of just offshore deposits of dollars in non-US banks. And this is really going to solve the global banking gap. And we're seeing this today in places like Latin America, Southeast Asia, Africa, where now you can download an app and all of a sudden be your own bank. And this is especially powerful for people who have been underserved by the global banking system. And we've seen this now, with Binance sort of acting almost as someone's own super app, right? In economies where they had sort of low banking access or were underserved by the incumbent players. The main other thing that we've sort of seen this year is a US policy pivot. So for the first time in what feels like a very long time, the United States government is fully behind stablecoins and digital assets. Scott Bessent, the U.S. Secretary of the Treasury, saying, hey, we're going to keep the U.S. dollar as the dominant reserve asset, and we're going to use stablecoins to do that. And I think it's because he sees the clear value of stablecoins in usurping euro dollars and, frankly, being a better form of money and payment system than what we have today. And when you have an army of private companies issuing dollars or building technology or financial service applications around US dollar stablecoins, it's going to push stablecoins into these markets in a way that the US government never could. So we're at about 230 billion in circulating supply today. That's primarily made up of USDT, USDC, so early movers, but ones that have really built network effects over the last 10 years. And I think we're going to start seeing an evolution not only in sort of stablecoin models, but also these yield coins taking share of some of this market. And I just wanted to share a little bit of data on where activity is occurring. And this sort of goes back to the prior slide where in developed markets, a lot of the activity is just trading, centralized crypto trading. But it's really in these emerging or developing economies where you're seeing a lot of stablecoin activity not happen on exchanges and happen because it's cheaper for remittances or because folks just want to hold dollars. I was in Turkey last week. Tether actually trades above $1 in Turkey because there's so much demand to get out of the local currency. And I think that's going to continue over the next 20 years. And what really has brought us to that $230 billion value is primarily trading, right? It's trading, a little bit of EM dollar demand and DeFi, but I think you're going to start to see a number of things that start to be growth levers on the adoption of stablecoins, which we'll get into in a moment. And you've also finally started to see the non-speculative adoption wave that we sort of all have said that will be coming over the last few years. So if you just look year to date, and this data is about a week off now, but stablecoin supply grew mid-teens, while the market cap of crypto itself is down 25%. And that is like a pretty clear divergence. And that's coming from cross-border payment companies, banks in non-US jurisdictions that are actually starting to use stable coins as a better form of money movement and just accessing the dollar. And so I think a number of different models are going to drive innovation here. So stablecoin 1.0 was Tether, right? They were the first digital dollar used primarily by trading firms and exchanges to move money from venue to venue and are different prices of Bitcoin, ETH amongst these venues. As crypto companies for a long time have been starved of access to the banking system. We're starting to see that with the U.S. change in policy, but we're not quite there yet. You had the 2.0 wave, which was you sort of the single partner model, which was USDC, leveraging Coinbase's distribution, Gemini trying to leverage Gemini's distribution, Binance trying to leverage their own distribution. But amongst all this, you had everyone else that was touching stablecoins cut out of this economic equation, but also this relationship. Many of these firms were not customer first, right? And so what we're doing with Agora is trying to bring everyone else sort of under this both economic umbrella through income sharing, but also just deliver better service, right? Build products alongside them, offer zero cost fiat on and off ramps. And ultimately, we think that this is, sort of this B2B approach is going to drive much greater adoption and frankly be better, right? If you look at the crypto ecosystem, these two large issuers are sucking billions of dollars out of these ecosystems every single year when you could be pushing that back to the builders in the space and frankly growing the crypto pie and also, I would say, the traditional company pie as they come into the space. And so what's next? That's where we are today. But we see a number of growth levers that are really going to take stablecoins to the next level. The first is payments. This is coming both at the merchant level, but the cross-border level. The FX market. Today, US dollar stablecoins are about 99% of the stablecoin supply. We'll see that change a bit. And I would say in a dramatic way to the state of the market today, but we still believe that US dollar stablecoins will be the vast majority of issued stablecoins. As institutional finance and applications and products come on chain, stablecoins are going to be that cash mechanism in a very similar way to how Tether was used at the early days of the crypto market to move between venues. Enterprise treasury management. So what I mean by that is think of Pepsi, right? They have suppliers in Mexico, Brazil, Indonesia, Singapore. They're moving money between their entities 24/7, and they have to pre-fund many of these accounts. They can now use stablecoins to move money 24/7, settle instantly for a fraction of a cost, and drive a lot of efficiency gains for traditional corporate business. Continued EM dollar demand, right? So that 1 billion plus population, I think, is going to get onboarded to stablecoins. And then we're also going to see a large amount of adoption when it comes to trade finance. And so if we just take merchant payments, most people don't know this, but there's many middlemen in the stack. And so, the move to stables, I think, will bring a lot of attractive unit economics to the merchants who have typically had to wait 30 days to get funded. They can now receive that money instantly and are cutting out a lot of the middlemen fees, right? It's 2 to 4% or more, depending on where you are, that they're paying to these acceptance networks and acquiring banks, payment aggregators just to run their business. And so you're going to see their margins expand in a really material way. If you look at businesses like Walmart, they're super slim margin businesses, but they're making tens of billions of dollars a year. If you take their sort of gross profit from, let's say, 10% to 13%, that is a meaningful amount of cash flow that goes back to the business. And so once this really starts, I think you're going to see it take off in a pretty exciting way. The other one is cross-border payments. For anyone here that has moved money cross-border, whether you're an individual or done so as a business, it can take days. Your funds can get held up, for sort of unknown reasons. And frankly, that results in a lot of different problems, right? You have to pre-fund accounts. You have lower capital velocity and lower capital turnover. And so we started to see a lot of PSPs and payment companies start to use stablecoins because you have instant settlement, and it's just that much better. And it's not like 10x better; it is 100x better. And so I think we're having a lot of early adopters now that are the smaller, hungrier companies, the startups, right, that are willing to take risks because they can go to their customers and say, hey, we can deliver a much better product than the existing big guys. But what I think will happen in about 3 years is the big guys will be like, wait, they're able to undercut us and still make more money. We need to aggressively move into stablecoins. And so that'll drive a lot of non-speculative demand for stablecoins. Cross-border payments on the retail level, you see this with individuals today. Remittances can cost, 10% or $10 on a $100 transfer. Stablecoins are just that much better, right? And so I think you're seeing a lot of individual adoption, and then individuals who are using this to send money back to their family actually start to run their businesses on it. And so you're seeing pretty, I would say, high levels of growth globally in terms of what % of those remittance rails are done via stablecoins today, but that's a lot of headroom, right? If we truly believe that stablecoins are, a 10x or even 100x better solution for cross-border payments, I think that this is the lion's share in 10 years. And, India's at 10% today. I wouldn't be surprised if they were at 80% or 90% in 10 years. And just to tee it off with payments, there's a lot of opportunities outside of, float income for stablecoin issuers. And I think you're going to see the rise of many of these issuers start to tap into transfer volume. So, what are we doing in cross-border payments? Partnering with local providers, whether those are PSPs, localized exchanges. You kind of have to build the whole network. And so that's what we're focused on doing. And you can see at a high level, why stablecoins are so much better than the existing systems. The next big market is going to be FX. And so, we're seeing this today, where a lot of different trading firms have the dollar leg on chain with USD stablecoins, but they don't have the euro, they don't have the Mexican peso, they don't have the rupiah on chain. And so this means that a lot of the processes are still extremely manual. I think you're going to see over the next 3 years the rise of a few dominant non-US dollar stablecoins that start to be used in traditional FX markets so that the entire life cycle of the trade and settlement can happen on chain. And I would like to point out that where these folks they're not really going to be able to monetize as much on the float as US dollar stablecoins, so they're going to have to figure out a way to monetize on that throughput and that transaction volume. And so some of the things that we're doing is working with local OTC firms to build pairs, against the Thai baht in Thailand, the lira in Turkey, working with local exchanges like Bitso to set up, MXNB pairs, both in DeFi, but also on centralized exchanges, and build, broader sort of non-USD liquidity. Talking about, institutional finance, I think this is still very early days. The only real products that we have on chain are, on-chain treasury funds, which are interesting, but they're not interesting if they're just on chain. What you need to do is actually have liquidity for these vehicles. And so what we've actually done is develop a product at Agora where you can have $50 million of BIDL that's on chain. But if you're a market maker and you can't get out of that 24/7, you're not going to touch that. Well, now what we say is like, hey, we'll take that BIDL as collateral against AUSD. Now you have a stablecoin that you can use on chain, move to different venues, and then we'll off-ramp that behind the scenes. And so I think there's a lot of work to be done merging both stablecoin issuers and a lot of these folks that are trying to bring traditional products on chain, and we're helping to do that. This is some of the things that we're doing. So enterprise treasury management, which is what I was speaking about earlier with regards to Pepsi. You have settlement time improvement, better operational efficiency. You can have a higher compliance rate too by building these private networks and sort of KYC'd enclaves, which we're working with a number of partners on. And so I think these folks will be slow movers, but they'll be really sticky when it comes to just having assets on chain. And so I think the Fireblocks of the world and the early custodians are sort of the V1 of what these systems look like for more traditional businesses like the Pepsis. And I think you'll see adoption happen at their supplier level first, but then that'll start to move into the broader corporate. And so this will be a huge driver of stablecoin demand. And it's not just large enterprises, but it's SMBs as well. I think SMBs are typically the first movers, but it's these big boys that are moving money 24/7 globally to different jurisdictions in and out of different currencies that are going to really benefit the most from having a financial system fully on chain. And then EM dollar demand, right? So you just see this, like the growth of stablecoin adoption in emerging markets where they're just trying to protect the value of their assets and their wealth is enormous. They're not, some of them are speculators and active sort of within traditional crypto tokens, but many of them just want to save their money. If you've grown up in a region where you have hyperinflation or a low rule of law, through no fault of your own, it's really challenging to build wealth for you and your family. And one of the beautiful things about stablecoins and frankly blockchain technology is that you enable anyone to be their own bank, whether they're living in a jurisdiction with hyperinflation or a low rule of law, or they're a refugee. And to me, like that's one of the beautiful things about this space. And you can see this in the data, when it comes to places like Argentina and Mexico. And then lastly, trade finance is the other big opportunity that we see. So I think a lot of folks don't talk about this enough, but Tether is one of the largest credit providers in all of crypto. And it's because they're smart. They know that if they are starting to put debt on their token, they're not only pushing adoption and growing supply, but they're building like real utility and solving real problems. And so I would expect that other issuers who think similarly are going to start getting into the credit game, because you can also deliver credit at a much lower rate without pricing the risk any differently, because you're making 4% or 5% on the back end. And this is something I'm super excited about, and a little bit of an alpha drop. So this is some of the things that we're doing sort of across the space and some of the growth levers that we see. I really wanted to cover the things that were primarily non-speculative demand, because I think that's what's going to actually take this industry from where we are today to become a true $10 trillion industry, not just in stablecoins, but really as blockchain looks to eat all of traditional finance and the world of payments. So yeah, thank you.